Good morning or afternoon, everyone, and welcome to today's webinar, Understanding ACA Reporting Mistakes and the Different Types of IRS Penalty Letters. We appreciate your time today, especially for those that are still in the middle of this crazy filing season with the deadline coming up. We appreciate your time spending with us today and learning about penalty letters. My name is Robin Carlini, and I will be your webinar moderator today. And a little disclaimer before we get started, SyncStream does not provide legal guidance or advice. You will still need to ask the advice of your legal counsel. However, we are ACA experts and we can answer questions around the ACA. And if you have a question, please type it into the Q&A box in your Zoom webinar menu. And this webinar is being recorded, so all registrants and attendees will receive the recording by Monday. And also, when you exit the webinar, a survey will pop up. If you don't mind answering those questions, that helps us, come up with topics for all future webinars. And I'm going to kick off the poll about the SHRM credit. Let me go ahead and get that one started. So if you are here today for that SHRM credit, please answer yes, please email me my certificate, or no, I'm just here for ACA knowledge. And everyone that clicks yes, you will receive an email with that certificate by Monday. Okay, thank you. I'll go ahead and end the poll. If you didn't have time to answer it, there's many ways to ask for one. You can just email me, put it in the chat box, I'll get it. Okay, and you are very lucky today. Today's webinar is extra special because I have not one, but two Stacy's co-hosting. It's like a buy one, get one deal, but instead of shoes, you're getting top tier ACA compliance insights. Stacy Barrow is presenting. He's our Chief Legal Counsel. He has extensive knowledge and experience designing and implementing health and welfare plans that meet numerous requirements. And if any advisors have more practical and hands-on experience assisting clients with the requirements of the Affordable Care Act, it is Stacy Barrow. And then we're also co-hosted today by Stacy Davidson, our National Sales Director. Stacy has been here with SyncStream for over 10 years. She has deep expertise in ACA filing and is assisting clients right now to get the deadline, to get their files in. And just a little background about SyncStream. We've been here since 2013, and this is a bit of our scorecard. And the ones that I'm especially proud of is 97% customer retention rate. Our customers stay with us year in and year out because they get hand-holding by our amazing ops team and that ACA knowledge. And Celerix acquired SyncStream Solutions, so we're part of the Celerix family now. And this acquisition creates one of the largest providers of ACA solutions in the US market. Together, we're expanding our ability to deliver ACA compliance and benefit admin services. So if you're in need of a ben admin service, this is the QR code with our information on our parent company. And our agenda, we're going to go through key issues that can trigger an IRS penalty letter with some year-end updates and legislative updates and deadlines. And we'll go over some form correction process and all the types of penalty letters. And again, submit your Q&A questions and Stacy will answer it at the end. And now I'm handing it over to Stacy Davidson.
Thanks, Robin. Hi, everyone. Thanks for being here today. At SyncStream, we really promote maintenance throughout the year for ACA compliance, really to reduce the administrative burden and to minimize compliance risks. So as usual, as we have these monthly ACA webinars, we're going to go over what what clients or employers should be doing for the month of March, which we know is the e-file deadline. So to ensure compliance, we recommend that you complete these tasks this month. You should have already furnished a 1095-C form to your employees. We know that there's been some changes in the legislation. Most people went business as usual, but even with employees that opted in, those should have been furnished by March 3rd, but there's still time. There is really, no penalties for not furnishing unless the IRS determines that you didn't furnish them at all. I should say there's no penalties for doing it late. So you want to still get those forms out while you can. Complete any edits that your employees may have come back to say, hey, my social's wrong or my dependent's birth date's wrong. So you can complete those edits, make those edits before you would e-file those to the IRS. And then obviously make sure you meet the deadline of March 1st to complete your e-filing of any 1094 and 1095 forms. You want to, wait for your receipt ID, which we'll be talking about later today, and anything that comes back from the IRS around a 1095-C form or 1094-C form that the IRS has issue with. And then most important, you want to confirm the IRS has provided a receipt ID. Look for that status. We'll be talking more about the statuses later. And always make sure that you keep documentation of your receipt ID and any copies of forms and really any kind of actions that you took around safe harbor calculations. It's important to keep those documents in the event that you get an IRS notice later on. And I know everybody will be thrilled to have this 2024 reporting season behind you, but it is important that you recognize that it is an ongoing process to maintain compliance. It doesn't stop on March 31st or as soon as you hit that e-file button. We're approaching mid-March, hard to believe, so we'll be in Q2 before you know it. So make sure that you continue to monitor your compliance, whether that is benefit eligibility tracking, making sure you're making those offers of coverage, confirming that it is affordable coverage, and all the things that can cause you headaches and potential penalties later on as you complete the 2025 filing. It'll be here before you know it.
Okay, and we have another poll question. Let me go ahead and get that one started. And this is just us being curious. Have you completed your 2024 ACA reporting? Is it yes, it's complete and I feel confident in our reporting? Is it yes, but I don't feel very confident in our reporting compliance? No, I'm still working on it. I'm unsure what I have to do still. Okay, it looks like 58% are finished and they are confident. Congratulations, you must be so relieved. 13% are finished, but they don't feel as confident in reporting, and 24% are still working on it. And I'm very happy that no one answered they're unsure. Okay, I'll kick it off to Stacy Barrow.
Great. So talk about changes for this reporting season for calendar year 2024. And thankfully, there's no fundamental changes to the process or the forms. All the coding is the same. The forms look the same. There are certain figures that change year over year. One of them is the federal poverty level safe harbor. If you are offering coverage that's affordable under this safe harbor, it allows you a little more succinct reporting. And this is essentially a very highly affordable offer of coverage that comes in at or below $101.94 per month. This is in connection with the 2024 affordability percentage of 8.39%. That's the lowest in the history of the ACA since inception, 2024's number. And it does increase a little bit in 2025 to 9.02%. And then, of course, the safe harbor for the FPL goes up to 113.20. Notably, number 4 here, this is actually new last year. This is the second year it's been in effect, but the threshold for electronic filing is lowered from 250 returns down to 10, and that aggregates all of the returns you're required to file. So essentially, if you're filing any of these forms under the ACA, you have to e-file them with the IRS. You can no longer do them by paper. And that applies to the 2024 forms we're filing in 2025. And then lastly, we have these 2 pieces of legislation we'll talk about in a couple of minutes: the Paperwork Burden Reduction Act and the Employer Reporting Improvement Act. Provide very limited reporting relief to employers going forward.
All right, now we're going to talk about some of the key issues known to trigger potential penalties or responses back from the IRS. On a 1095-C form, that can be a clerical error, a name and social mismatch. Ironically, I saw one of the the questions, the Q&A already came in about a name and social mismatch response from the IRS. We'll talk about that. But if the IRS has a discrepancy in their database with what you're reporting as the social security number and the name, you would get a message around that from the IRS in response to your 1095-C or your 1095-C filing. So it's important that you're confirming and having accuracy in your employees' name and social as they've presented it to you upon employment with a social, what's on their social security card. So just obviously clerical mistakes can cause a return from the IRS in the form of a name and social mismatch. Coding on the forms can cause future issues with penalty letters. The coding on lines 14 and 16 tells the story about, your offer of coverage and whether it was timely and affordable. So any code combination that presents itself as non-compliant could cause you future problems with 226J letters, or are likely even, upon receipt from the IRS. If it's a code combination that doesn't make sense, they're going to, give you a response around that. So it's important that you've done a review and audit of the codes that you're presenting to the IRS on a 1095-C form. So again, the 1094-C form about the employer, the transmittal form, you want to confirm as you're filing that to the IRS with your 1095-C forms about your employees that this information is accurate. So you have your EIN number, your official legal name, the name of the the company name, the legal name, I should say. You want to make sure you have someone as a contact with a phone number at the employer location that the IRS, if they have any questions or employees have any questions, that they can contact. And very important, as you are submitting your 1094 form to the IRS, that this MEC indicator here, which is highlighted, that if you have offered 95 full coverage to 95% of your full-time employees, MEC coverage, I should say, minimum essential coverage to 95% of your full-time employees, that is indicated. If that says no, then you're likely going to get, something back from the IRS around a penalty. That's the A penalty. And just a note, if you are using another software vendor to do your filing, perhaps a payroll vendor or another, third-party vendor, You'd be surprised how many times these 1094-C forms go out without that box checked, even though that's not maybe the situation, that you did offer coverage to 95% of your full-time employees, but that gets missed somewhere in the transmittal. Doesn't get checked off, and then you're going to have headaches around that. So you want to make sure, even though somebody's taking care of it for you, that if that is the case, that you have those boxes checked.
Yeah, so, how do the penalties get applied? And a penalty can only be applied in terms of the employer shared responsibility. The pay or play penalty can only be applied if a full-time employee receives a premium tax credit. And so a premium tax credit is an advanceable, refundable tax credit that allows folks to go out and get group health insurance coverage through the exchange or the health insurance marketplace. And so a question that often comes up is, well, can someone who's offered employer-sponsored coverage qualify for a premium tax credit? And the answer is maybe. If the coverage is unaffordable, then yes, very likely they can qualify for a premium tax credit, particularly through 2025, given some enhancements that were made under the Inflation Reduction Act that make more people eligible for a tax credit. Now, if you're offered coverage that's affordable, then as an employee or individual, you shouldn't be able to get a premium tax credit, but it's a little bit squishy. For example, if you're an employer and you're offering coverage that's affordable under the W-2 safe harbor, what that means is your offer of coverage ensures that you as an employer will not get penalized. The employee potentially could still be eligible for a premium tax credit. Their modified adjusted gross income may be low enough, below their Box 1 W-2 wages, that they can still qualify for a tax credit and may make the coverage unaffordable to the employee. In most cases, though, if they're offered affordable coverage, they really shouldn't be getting a premium tax credit. So when a full-time employee gets a premium tax credit and the employer reports that individual as being full-time and not having received an offer of coverage or an affordable offer of coverage, one of two penalty regimes can apply. They call them the A penalty and the B penalty based on the paragraphs in the law where they appear. So the first one is the A penalty, and this one they call the sledgehammer penalty. And this just requires that you offer at least some form of health insurance coverage to 95% of your full-time employees, including full-time equivalent employees. Doesn't have to be major medical coverage. It can be one of these skinny plans, a neck plan as they call them, but you have to at least break the ice and offer something. Failure to do so can result in a penalty of around $3,000 per year per full-time employee minus the first 30 full-time employees. And so this gets triggered if even one full-time employee gets a premium tax credit when you fail to offer coverage to 95%. Now, assuming you do offer coverage, the only penalty that theoretically would apply is the B penalty, and that is for a failure to offer affordable coverage, or maybe a couple people slipped through the cracks and they weren't offered coverage, then they can trigger a penalty. It's a little bit more, but it only applies for each employee who actually went to the marketplace and got a premium tax credit. So if you had 3 employees who went to the marketplace, the penalty would be roughly $13,000, 60 times 3. So ACA penalty letters.
We are going to kick it off with a poll. Let me go ahead and get that launched. Okay, what are the reasons that a company might receive a penalty letter from the IRS? Is it failure to file or submit incorrect forms? They did not offer minimum essential coverage to at least 95% of full-time employees? Or is it one or more employees received that premium tax credit? Or is it D, all of the above? Okay, Stacy, we have some smart people on the line today. Only 2% said failure to file or submit incorrect forms. 9% did not offer met coverage, and 86% all of the above.
Yep, indeed. Essentially all of the above. So digging into it a little bit, why did I get this love letter from the IRS? Well, if it's an ESRP letter, you failed to offer coverage or affordable coverage to at least one full-time employee, and you have at least one full-time employee receive a premium tax credit. So those two things have to happen. You can't be penalized unless you have at least one employee who went to the marketplace and got a premium tax credit. And now that could happen. The penalty letter could occur by a simple reporting error. Maybe you did offer affordable coverage, but like Stacy was saying, for some reason, the vendor didn't quite pick it up right. Or the way they calculate things is a little off, but it can sometimes just be, simple errors. Now, perhaps a little more difficult to get out from under sometimes is if you didn't report at all, then you can receive a penalty letter. We'll talk about those in a minute, but typically you'll get a chance to actually do the reporting before the penalties start getting imposed. So let's start out with the failure to file letters. And these can be a little misleading. You see there's a picture there of it on the slide, and it really isn't much more than that. It's a couple of paragraphs. The IRS refers to it in their parlance as a courtesy letter. And they're basically reaching out to you to say, hey, we think that you are an applicable large employer for the year in question, and that you should have filed your 1095 and 1094C forms. And it says, please respond. You have 30 days to respond. And you can check a box on the back that says, oh, we did file. Here's our confirmation number. Oh, we filed under a different EIN. Here's the right EIN. Or, oops, we are a large employer and we're going to file. Give us 90 days. We'll get our act together and we'll file. And if you respond to this letter and you're a large employer and you do end up being able to file within, say, 90 days, it should be no harm, no foul, and very likely to just kind of, get the forms filed, you respond timely to these letters, and you shouldn't have any penalties imposed. Now, what happens if you miss the letter 5699? You disregard it, you don't recognize what it really is asking. You've sent it to so-and-so, they didn't respond. The IRS is going to send another one. And eventually, maybe the second or third letter is going to be a letter 5005A. And then they're going to say, all right, you didn't respond, so we're going to assume that you agree with us, you were a large employer, and you didn't file the forms. So we're going to propose penalties. And since we don't have your forms, the only way we know how to come up with a number is to look at your W-2s. And so they'll propose a penalty based on the number of W-2s that are filed by the employer for that calendar year. And usually that's a lot more than the Form 1095Cs that you were supposed to file, because those only go to full-time employees. So if we take a look at what the proposed penalties could be there's one form, 1095-C, and the copy goes to the employee, and a copy also goes to the IRS. So one full-time employee can generate a penalty of $330 times 2, one for a failure to file with the IRS and one for a failure to furnish the form to the employee. And so the IRS might say, you have 230 W-2s you filed for, say, 2022, which is the year they're currently looking at. And they'll multiply that by 330 and then multiply that by 2. And so now your failure to file and failure to furnish penalties are $151,800. And that's before you get to the ESRP. And now you could have, gotten this resolved before it gets to this point if you timely respond to these letters. You have to at least get on the board with them. You can get extensions. There's all kinds of things you can do to stave them off. But what'll happen is if you don't respond to letter 5699, you don't respond to the letter 5005A, once they impose these penalties, it moves from the ESRP unit, which are the people that know about this stuff, to collections. And now, you owe the IRS $151,800. The folks in collections don't know really much about the ACA forms. They just know that you owed some forms and you filed them late. And it's time consuming, and there's no guarantee that you get these penalties waived. So I would do everything you can to avoid failing to timely file these forms. So assume you do file the forms, eventually the IRS will get around to adjudicating them. They're just moving on to 2023 now. I think we've seen our first letter for 2023 just recently. So you can see they are at least a couple years behind in enforcement, but eventually they'll look at your forms, they'll see who are your full-time employees, and then did any of them get a premium tax credit? If they did, and your reporting doesn't have a valid safe harbor code for them, then you get a letter 226J that proposes an employer shared responsibility payment. You get that letter. We'll talk about how to read it, respond to it. Then once you do, you send a response back to the IRS, and then they'll follow up with a letter 227, either J through N, essentially, that will either waive the penalty or ask for more time, or maybe they'll propose a recalculation, or they'll just accept your answer. So that could be one of the responses. And so again, this letter gets triggered if you have at least 1 month in the year where you had a full-time employee that was enrolled in subsidized coverage through the marketplace, and the employer listed that employee as full-time and didn't use an affordability safe harbor, didn't qualify to use one, or some other relief, like the employee wasn't in a waiting period, wasn't offered affordable coverage, didn't work part-time, there's no valid defense for the penalty. And so the letter itself will then describe how they've gone about calculating the penalty. There's this table in there, the ESRP table in bullet number 2. And it's important to get your hands on that part of the letter. Sometimes because the letter is double-sided, by the time someone that knows what they're looking at gets a copy of it, it might not have all the pages, but you want to make sure you have that table because that tells you whether it's imposed under penalty A or penalty B. There's a form that you fill out, the response form, that you're basically signing that you either agree or disagree with the penalty, and then the premium tax credit list to show you which of your employees receive subsidized coverage, and then you can use that as part of appealing the proposed penalty. So, help, I received a love letter from the IRS. What do I do? We do recommend that you consult with counsel when you receive one of these. I know first instinct, send it to your broker, which is not a bad start, or to your ACA filing vendor. But if time starts to tick by, you should find a qualified ERISA attorney like myself that can assist. But basically, once you get one of these penalty letters, you take a look at it, and sometimes you may agree. It may be accurate. You might have strategically exposed yourself to a penalty, and now it's here, and the reporting is done correctly, but you still, some people got a premium tax credit, so now you owe a penalty. So either you can respond and say, I agree, and either include payment or wait for a notice and demand to arrive. More likely it is, hopefully, you have a way to appeal the penalty letter. Again, perhaps you could have used the safe harbor code but didn't. Happens all the time. And so if that's how you're going to appeal, then you should indicate the coverage was affordable, provide acceptable proof. And again, you want to say this in a way that the IRS will understand. They don't want you filing corrected forms, but there is kind of a prescribed way to respond. It's detailed in the letter, and we're happy to help with that as well. So here's just a good checklist to keep in mind in general when dealing with the IRS. Timely open all mail, stamp it, let the person going through it in the future know when it was received. Check when it was mailed, check the due date, which form it's pertaining to, the reporting year, which tax year it is, the company's EIN, the penalty amount. These are all very relevant aspects to kind of figuring out what's going on. Check the reply address. Make sure you're responding to the address that's noted on the letter. There are lots of different IRS offices out there. You may want to request an extension if it's something where you're going to have to go digging through information from 3 years ago. Get on board with the IRS again, say, look, we've received the letter. We need some time. They're willing to work with you when you get to them relatively early. And then just kind of research the issue. Whether you're going to defend what you reported previously, whether there's any corrections to be made. Sometimes you think coverage is affordable under the W-2 safe harbor. The IRS may disagree. So you might have to provide some backup and explain how you calculated your compliance with that safe harbor. And then, respond, follow up timely, save everything that you sent to the IRS when it was sent. Just keep good records. And again, we highly recommend engaging counsel if it's, particularly if it's, a hairy penalty where, it's from 3 years ago. No one currently, the company was even around then. No one knows anything. You need someone to help with that. So there were some very minor changes toward the end of 2024 that impact the 2024 filing season that we're in the midst of right now. There were 2 laws that were passed. President Biden signed them into law right around the end of the year. They were the Paperwork Burden Reduction Act and the Employer Reporting Improvement Act. They give very limited relief, but the most significant part is it allows employers to meet their requirement of mailing these forms to employees by providing them with notice that the forms are available upon request. we'll talk a little bit about how to do this. You generally have to put a notice on your website, and you also have to be prepared to provide the forms by January 31st or within 30 days of request. And like Stacy Davidson mentioned before, if you're mailing the forms, you have until March 3rd to mail them. So if you're going to do this notice provision, you have to have them ready a little bit earlier, at least based on current guidance. Notably, though, this does not relieve employers of their responsibility to e-file the forms with the IRS. You have to continue to file the forms. This is just about not having to furnish them to employees. Any of the state-specific requirements are unchanged by these requirements. So if you're in California, Massachusetts, those states that also require forms to some degree, those requirements are still in effect. And the requirement, if you're going to do the notice to employees without actually mailing the forms to them, you're supposed to provide a notice on your website by March 3rd of 2025 that the forms are available upon request. Generally have 30 days to provide them. But I suspect many employers for the 2024 forms probably mailed them out for this year. Then the other law is the Employer Reporting Improvement Act. This just codified a previous bit of regulatory relief. You can furnish these forms electronically with employees' consent. You don't need that consent renewed each year. This is something that really we could already do. If you are missing Social Security numbers for a spouse or dependent, you can use date of birth in lieu of a social. Doesn't apply to the employee's social. You do need a valid social for the employee. You get 90 days now to respond to an initial 226J letter. That's up from 30 days prior. And they also established a 6-year statute of limitations for the IRS to seek an ESRP penalty starting from the date that you filed the forms if you filed them timely. And there's a question here that it's timely, so I think we should address it. It says, is the website the only place to inform employees that the forms are available upon request? So the issue is that the notice has to go to everyone who is entitled to receive a form. And so that could be current or former employees, full-time employee who terminated during the year. So if you use an internal website that only employees have access to, then you'd still have to mail the forms to former employees. And the law in the notice, the IRS notice, it talks about the employer's website. It doesn't talk about a payroll company's website. And you could always use a belt and suspenders approach, but it does seem that the guidance contemplates it's the employer's website and can be accessible, by anyone who's entitled to receive a form. So, maybe not the only way, but I think I would put it there in addition to other ways of notifying employees, like notice in the break room or the payroll stuff or something like that.
So we anticipate that, moving forward, especially since as employers get finished with their 2024 filing, that they're going to take into consideration some of these new legislative changes and, put those into their business practices. Like Stacy was just talking about, put it on your website or communicating, about the Paperwork Reduction Act to your employees, possibly, to put that in effect for 2025 filing. So as you start to consider, how you're going to approach, ACA fulfillment moving forward, we anticipate that these will be some possible challenges to that. One, how are you going to monitor instances when employees request their 1095-C forms? The responsibility does lie with the employer to maintain proof of compliance for 7 years after the form is provided. You know, in lieu of printing and mailing, you know, you can have a digital fulfillment option. You know, how are you going to do that to, you know, help reduce paperwork? Some vendors have fulfillment, options, I should say, within their software. So that's something that you might want to consider in enhancing that as part of your business practices to be able to electronically send these forms out. What are the risks for non-compliance? The burden always rests with the employer. We like to say you're guilty until you prove yourself innocent. So any gaps or inconsistencies in reporting or your processes could enhance some further issues or risks moving forward. We were kind of talking about this before everybody got on. Employers must ensure that reduced paperwork does not compromise the accuracy or completeness of data. Internally, we see that our clients really, go through the 1095-C forms and the codes prior to print and mail. But if that's not going to be your practice moving forward and you're not going to be printing and mailing, are you still going to go through each form to ensure accuracy, to monitor for any compliance risks? So you don't want to lose sight of the compliance, aspect of reviewing the codes on forms that typically happened prior to print and mail. And then as Stacy alluded to, just making sure that you are aware that while, this is a federal change, it hasn't changed at the state level just yet. So if you have employees that reside in California, Rhode Island, DC, New Jersey, Massachusetts, that you're aware of your obligations that could still possibly be printing and mailing those forms for 2025. And we can't reiterate this enough because I've already gotten questions about this, which is a little concerning. The Paperwork Reduction Act does not resolve employers from having to e-file the 1095 forms to the IRS. So those 1095-C forms still need to be produced. They still need to be accurate. There's still, nothing's changing about that obligation to e-file to the IRS. So make sure that that doesn't get lost in not having to actually print and mail them anymore. So let's just review the deadlines. I know a lot of you from the survey are already there, but the print and mail deadline was March 3rd. You can still get those out to your employees if that hasn't been done. The March 31st is the deadline to have those e-filed, the 1094 and 1095-C forms e-filed to the IRS. We don't recommend waiting to March 31st to do that. We have an internal deadline of March 25th because so much can be left at the at the IRS end. So if you get a failed validation, something is rejected, you would still have time to address those prior to the March 31st deadline. So just keep that in mind. And then August 1st, as we'll allude to in a couple of slides, is really where the maximum penalties kick in for being late.
Okay, I'll go ahead and launch our last poll. I want to thank everyone for their participation in these. Okay, how long do you have to amend forms or submit corrections to the IRS? Do you have 15 days, 30 days, 60 days, or 90 days? Okay,
This one keeps moving.
it keeps moving. Okay, it stopped moving. So 39% say 30 days, 21% say 60 days, and 41% say 90 days.
Well, the answer is 60 days, and we'll talk about that in the next few slides. So you get an automatic 60 days to make proactive changes. Let's say in reviewing, you're doing some audits post filing, that you've determined that you need to make some corrections. You have 60 days. Let's say you have, even a rejected status or something from the IRS. You want to get your receipt ID, for sure, but you still have 60 days. Post that 60 days, then there can be some fines around being late, right? So there could be, after, what is that, June 1st? April, May, yeah, June 1st, there could be, fines after being 30 days past. Before August 1st, there could be some additional penalties per form for being late. And then the maximum penalties are after August 1st, where there's full exposure for not getting corrections and or, obviously your initial filing in on time. And we don't want to forget about the state filing deadlines. I think the slides might have gotten a little mixed up, but the states that have these obligations, if you have employees that reside in these states, regardless of where your headquarters are, if you have employees that reside in these states, you have the obligation to provide 1095-C forms, and these are the deadlines for each of those states. Okay, so as you, for those of you who are still working on this process, what are some of the responses that you can get from the IRS? And this would lead you to know whether or not you need to make corrections or, need to do some further work. I like to say you get accepted, it's golden, right? The IRS has no conflict with anything in any of your forms. You could also have an accepted with error status. One of the first questions was, a response about a name and social mismatch. That would be an accepted with errors. It's very common to see a name and social mismatch as an error. That does include a receipt ID, which is confirmation that you have completed your filing. And these issues that the IRS has, these errors per se, just as it's something in their database for that employee, whether it be their name or their social doesn't match with what you reported. We always recommend that you go and confirm that the social that you e-filed to the IRS is the one that, is accurate, that you were provided, that it's not a typo or something like that. You could still get a receipt ID and still have a processing status. And that's just that the IRS, has confirmed that you got it, that you're going to get an accepted or accepted with errors, but they're just still processing what that status is going to be. There could be a partially accepted status that would obviously have you looking further into what needs to be corrected so that you can get that back to the IRS. And failed validation and rejected, obviously the IRS hit the IRS, air system, and it says, no way, we're not taking this. It could be for a variety of reasons. I think we're going to review some of those reasons in the next slide or slides. Corrections can only be made to previous transmissions that have been accepted with error or partially accepted. If it's, failed validation or completely rejected, that wouldn't be part of the correction process. That would be a new submission. So a correction would be anything, corrections basically, technically, that you would make to a form that has already been accepted with error or partially accepted from the IRS. So it is used to correct either a 1095-B, a 1095-C form, both are about employees, or a 1094-C that is the authoritative transmittal. The IRS may have accepted the return, even if it included errors, in which case an error report will be generated. The 1094, any of those three forms, the 1095-B, the 1094-C, the 1095-C, could be, corrected information about the employee, social name, such like that. A B transmittal for a 1094-B does not really have that much information. So there would not be a need to have a correction, nor would you receive a response about an error on that. And then any 1094C that is not an authoritative transmittal does not allow for corrections. This is a 1094C form that is an authoritative transmittal. What could possibly be some of the corrections that would need to be made on this? It could be a minimum essential MEC coverage offer indicator, all here, the aggregated group indicator, a full-time employee count for an ALE members, cross-referencing other EINs that are in an aggregated group, ALE, the name or EIN for sure, total number of forms, 1095C forms that are accompanying this filing, or any certifications of eligibility. And I think no, that's right. Okay, I was thinking of something else that could be changed, but that would be on the 1095C form. Go ahead to the next slide. Information that could be corrected on a 1095C form. Kind of mentioned that: employee name, their social, any of the code combinations, the employer EIN number, I guess, could come back wrong on the 1095s if it's wrong on the 1094s. We do get some changes around an error where the plan start month comes back if the IRS, if it doesn't have a leading zero from January to September, that could come back as a need for a change as well. The IRS would have a problem with that. Okay, kind of big picture. Some steps just to make sure you have successful ACA reporting and compliance, kind of best practices, I would say. Make sure you take proactive steps to safeguard your compliance, your company with your compliance around affordability, or at least have a plan for how you're going to approach offers of coverage, affordability, or even if it's not offering minimum value, that you're offering MEC to 95%. I mean, the IRS isn't going to stop with this enforcement, so just make sure whatever your plan is, that you're at least addressing compliance and how you're going to address non-compliance. If you are perhaps feel like you would be susceptible, or any of your clients would be susceptible, you want to make sure that penalty letters or any notices, I mean, they're not all penalties, we call them penalty letters, but they're just, can be initial notices, that they don't go unnoticed. Once those things start escalating, that's really, as Stacy Barrow mentioned, you really, have a harder time mitigating any penalties and really, helping your case that way. You want to have an electronic filing plan in place. That is, like we said, was new last year. Some people did file a way to get those paper forms still in last year, but that should be something, especially for those smaller employers. Accuracy is key. Backing up your data is key. Having tracking reports, anything that can go towards defending any future penalty notices would be great. Best useful for your company. And then remembering that the good faith effort is no longer in place. Mitigating penalties is more difficult. So like I said, keep source documents, keep source data. Most important, if you are switching payroll providers or other softwares who have handled this, make sure you pull all of your records from, even source data from those platforms, to ensure that you have what you need to defend yourself in the future. Stacy said we're just on 2023. Anything could come up 2 years later, 3 years later, and you won't have any source documents if it's still in a previous payroll provider's software. Believe me, we've helped clients come to us in a panic. They've become clients because they had a need, and we're like, okay, where's your source data? And it's really going back and trying to recreate something that could have easily they benefited from if they would have pulled that from their platforms before they left.
Okay, and I'll go through a little bit about SyncStream real quick so we can maybe answer a question in a minute. Our staff is tenured, as I mentioned before. We've all been here since about the inception of the Affordable Care Act. You get legal expertise and a certified ACA expert. You receive a designated account manager that you will have meetings with every month for handholding. State filing is included. I also want to mention, if you're not a client and you receive any of these letters, we are very experienced with past year's filing. So we have a lot of clients coming on with a letter, and then they're able to file past years with us. And this is a QR code for next month's webinar. We're going to start with the 2025 filing season from the beginning. So we have ACA for Dummies, back to the basics of ACA reporting. And thank you for attending. We might have a minute or two for a question. Stacy, do you want to go through the questions? Let's see, what happens if they did not file last year's 1095s? For example, you got the group from another broker and took over.
Yeah, you should generally have the forms filed. I mean, that's the gold standard. There's really not much of a basis not to file. It's really a risk management decision for the company, but we'd always recommend that they file.
And Stacy Davidson, I think you answered this previously about
The name and social mismatch.
yes.
Yeah,
yes.
so Larice, that was a name and social mismatch. What the IRS saw on your form didn't match what they have in the database. Very common. Just confirm that you have the social, that what you filed is what you were provided. And then I would say, Lydia, if you're, or anybody who's using another vendor to do your filing and you haven't received filing confirmation, that's something that you want to make sure that they're not going to take responsibility. Another vendor is not going to take responsibility. Software is not going to take responsibility. It's you as the employer that's responsible for getting the receipt ID. So I would ask them for confirmation of your receipt ID and status. And then if they can give you visibility into what those errors are, then you can ask them to do the correction process for you.
Okay,
Stacy,
do we
want
to take the very last question?
Yes,
it's the only other question we can take.
It's the only one I think we have, this too. So.
Is that the one for 2022?
Yeah.
Yes.
We're 52 employees, 2023 above 50, but in 2024 we're below 50. We filed in 22 and 23. Is it okay if we don't file for 2024, or we need to file as we did it for 22 and 23? You only need to file if you're an applicable large employer. I can't tell if you are, from the information that you provide here, right? I mean, if you're below 50 in 2024, that just means you won't have to file. You won't be an ALE in calendar year 2025. It won't have to file in 2026. So if you are above 50 in 2023, you do need to file for calendar year 2024.
Okay, perfect. And I have my information up here. Everybody will be receiving a recording. And if you want the slides, a copy of the slides, please email me, because that is only upon request. And I want to thank Stacy and Stacy for their ACA knowledge and their time today. And thank you for all our attendees for spending the morning with us. Good luck with filing.
Thanks,
We'll see you next
everyone.
month.